Have you ever wondered whether it's better to invest all your money at once or to spread it out over time? This is a common dilemma for investors, and the answer really depends on your financial goals, risk tolerance, and investment horizon. In today's video, we'll take a deep dive into two of the most popular investment strategies: Systematic Investment Plan, SIP, and Lump Sum Investing. We'll compare their pros and cons and help you understand which strategy might make you richer, faster. Let's start by talking about SIP. A systematic investment plan, or SIP, is a disciplined approach to investing where you commit to investing a fixed amount of money at regular intervals, be it monthly, quarterly, or even weekly, into mutual funds, stocks, or ETFs. Let's say you decide to invest $100 every month. The beauty of SIP lies in its simplicity and consistency. You don't have to time the market or worry about whether today's price is the best you can get. Instead, you invest regularly, no matter what the market is doing. One of the most powerful benefits of SIP is dollar cost averaging. This means that by investing a fixed amount every month, you end up buying more units when the prices are low and fewer units when the prices are high. Over time, this smooths out the impact of market volatility. It's like filling up a water tank at a steady rate, no matter if the water levels are high or low. SIP also removes the stress of market timing. Many investors struggle with the fear of buying at the wrong time. By following SIP, you don't have to worry about timing the market. You're investing consistently, which ensures that you're steadily building your wealth over time. Another major advantage of SIP is that it's affordable and accessible to everyone. You don't need to have a huge lump sum to get started. You can start investing with just $10 a month. This makes SIP a great option for new investors, those who are just beginning their wealth-building journey, or even those who don't have a large amount of capital available right now. SIP encourages disciplined investing, which is key to long-term success. Now let's take a look at lump sum investing. Lump sum investing is when you invest a large amount of money all at once into the market, rather than spreading it out over time. For example, if you received a bonus or inheritance, you might decide to invest that lump sum of $10,000. The main advantage of lump sum investing is that you get immediate full exposure to the market. Your entire investment is at work right away, and if the market is on an upward trajectory, your wealth can grow faster. However, lump sum investing comes with its own set of risks. The biggest risk is market timing. If you happen to invest your lump sum when the market is at a peak and it crashes soon after, you could face significant losses. Timing the market is very difficult, and while the potential rewards of lump sum investing can be high if the market performs well, there's also a risk of loss if market conditions take a turn for the worse. Think of lump sum investing like diving into the deep end of a pool. If the water is calm, you'll float smoothly and make the most of the experience. But if there are waves or turbulence in the water, you might struggle. The key is that lump sum investing requires a strong understanding of market conditions and a high tolerance for risk. Let's now compare how SIP and lump sum investing would perform over time. For the sake of simplicity, imagine two investors. One invests $100 every month through SIP, and the other invests $10,000 all at once. We'll assume an average annual return of 12% over the next 20 years. After 5 years, the SIP investor has accumulated around $8,000, while the lump sum investor has grown their $10,000 to $18,000. Fast forward 10 years, and the SIP investor has about $22,000, while the lump sum investor's investment has grown to $35,000. After 15 years, the SIP investor has around $50,000, while the lump sum investor has about $75,000. Now here's the most interesting part. After 20 years, SIP has managed to catch up and even surpass lump sum. The SIP investor has nearly $100,000, while the lump sum investor has just $96,462. What does this tell us? While lump sum investing tends to outperform SIP in the short term, SIP has a unique advantage in the long term. The regular contributions over time allow SIP to benefit from compounding, and the steady nature of the strategy means the investor avoids the risk of market timing. This shows that SIP might be the better choice for long-term growth, as it reduces the impact of short-term market fluctuations and benefits from the magic of compounding. Let's dive deeper into one of the biggest risks of lump sum investing: market timing. When you invest a lump sum, you're putting your money into the market at a particular point in time. If the market is high and you invest just before a downturn, you're at risk of seeing your portfolio lose significant value. The stock market doesn't move in a straight line. There are always ups and downs, and trying to predict those movements is extremely difficult. This is where SIP has a clear advantage. SIP investors invest regularly, which means they're not exposed to the same level of risk as lump sum investors. When the market goes down, SIP investors are still purchasing shares at lower prices. In fact, market crashes can actually work in their favor, as they're able to buy more units for the same amount of money. Let's take a look at two historical events: the 2008 financial crisis and the 2020 COVID-19 market crash. In 2008, the market crashed, and anyone who invested a lump sum before the crash saw their portfolio values plummet. However, SIP investors continued investing regularly throughout the downturn. As the market recovered, those SIP investors saw their portfolios grow significantly, thanks to buying stocks at a discount during the crash. Similarly, during the COVID-19 market crash in 2020, lump sum investors who had invested just before the crash faced huge losses. Meanwhile, SIP investors continued to buy stocks at lower prices, and when the market bounced back later in the year, they saw substantial gains. Investor psychology plays a huge role in these decisions. Many investors make emotional mistakes when it comes to market investing. FOMO, or the fear of missing out, can drive people to invest when the market is high, out of greed. On the flip side, panic selling can cause investors to lock in losses when markets fall, instead of staying calm and sticking to their strategy. Another common mistake is overconfidence, believing you can perfectly time the market. But as most seasoned investors will tell you, timing the market is nearly impossible. That's why SIP is such a valuable tool. It helps remove emotions from investing, ensuring that you stay consistent and disciplined. Some of the most successful investors combine both strategies. This hybrid approach allows you to take advantage of the benefits of both SIP and lump sum investing. For example, you might choose to continue your regular SIP investments but keep a reserve of cash available to deploy during market dips. When the market drops, you can invest your lump sum to buy assets at discounted prices, boosting your portfolio's performance. Let's wrap up by considering which strategy is right for you. Your choice will depend on several factors, including your risk tolerance, your investment horizon, and your cash flow. If you're comfortable with the risks of market fluctuations and have a lump sum available to invest, lump sum investing might work for you. However, if you prefer a more disciplined and consistent approach with lower risk, SIP is generally the safer choice. If you have a lump sum but want to minimize risk, you might want to consider a hybrid approach, investing part of your money through SIP and deploying your lump sum during market dips. This strategy gives you the best of both worlds. In conclusion, both SIP and lump sum investing have their pros and cons, and the key is to choose the strategy that best fits your financial goals and risk appetite. The most important thing is to stay consistent and avoid making emotional decisions based on fear or greed. By following a strategy that suits you, you'll be well on your way to building long-term wealth. So, what's your approach? Are you Team SIP, Team Lump Sum, or a hybrid investor? Let me know in the comments below. The road to financial freedom is paved with smart, disciplined decisions. Start investing today, stay patient, and watch your wealth grow over time.